Welcome to the Deep Dive. We're here to give you that shortcut, that quicker way to grasp complex topics.
And today we're digging into a really interesting one. It's Charles T. Munger's 1997 shareholder letter for WESCO Financial Corporation.
Yeah, it's a fascinating document. We'll look at Munger's role there back in '97, where
Yeah.
WESCO actually did its businesses.
Right, and importantly, what timeless ideas Munger packed into this single letter. Ideas about business, investing, even human psychology.
You'll really get a feel for how his mind worked, the mind of, well, one of the investing greats.
Our mission here is pretty simple. Pull out the key insights, the real nuggets of wisdom.
We want you to see not just what happened back then, but why Munger's way of thinking is still so relevant today. Let's get started.
Okay, so setting the scene. 1997. Charles T. Munger is chairman of the board at WESCO Financial.
And WESCO wasn't just some standalone company, right? It had a very close connection to Berkshire Hathaway.
Exactly. It was technically the ultimate parent, but Berkshire owned about 80% of it. So deeply intertwined.
And the letter itself, the primary purpose was, well, standard stuff, informing shareholders about performance, strategy.
On the surface, yes. But with Munger, you always got more. He used it as a platform for teaching, really.
So let's talk about WESCO's businesses then. What was under the hood in 1997?
Well, it was kind of a mixed bag, which is interesting in itself. Three main areas. First, WESCO Financial Insurance Company, WESFIC, based in Omaha.
And their main thing was reinsurance.
Primarily, yes, reinsurance.
Maybe just quickly for listeners, what exactly is reinsurance?
Sure. Think of it like insurance for insurance companies. If a primary insurer writes a huge policy, say, for potential earthquake damage, they might pass some of that risk and the premium onto a reinsurer like WESCO.
Got it. Spreading the risk of those massive, unpredictable events.
Precisely. So that was pillar one. Pillar two was the Kansas Bankers Surety Company, or KBS.
Yes, okay.
WESFE had bought them in '96 for around $80 million cash. And KBS had a very specific niche.
Which was?
Insurance products just for Midwestern banks. Things like deposit guarantee bonds.
So protecting the bank if something happens to a customer's deposit.
Exactly. Also, directors and officers' indemnity policies, D&O insurance for bank execs, and even bank employment practices policies covering things like wrongful termination suits.
Wow, very specific. Sounds like a solid, focused business.
It was. KBS chipped in over $6 million to the insurance group's profits in '97 alone.
Okay, so insurance and specialized bank insurance. What was the third pillar?
Something completely different. Precision Steel. They were based near Chicago in Franklin Park, Illinois.
Steel. So an industrial business.
Right. Steel warehousing and specialty metal products. And they were doing well, too. Their operating income was up 19% in '97.
Why the jump?
Mostly because they sold more product. About 15% more pounds of steel shipped out the door. Solid, if not flashy.
It's interesting how Munger held on to these seemingly unrelated businesses. Were there any leftovers from WESCO's past, maybe from its savings and loan days?
Yeah, a couple of tag ends, as Munger might call them. There's a small real estate subsidiary, MS Property Company, with maybe $13 million in assets. Not huge.
Okay.
But the big one, the really significant legacy asset, was a massive holding in Freddie Mac, Federal Home Loan Mortgage Corporation.
Ah, Freddie Mac. How much did they have?
They filled 28.8 million shares, originally bought by WESCO's old S&L for just $72 million.
And by the end of '97?
They were worth, wait for it, $1.2 billion.
Wow. Just wow. That's incredible. That $72 million turned into $1.2 billion.
Yep. Sitting inside the insurance subsidiary, WESFIC, a classic example of long-term holding paying off spectacularly.
Any other income streams?
Yeah, a bit more. Income from the WESCO headquarters building in Pasadena, they leased most of it out. And, standard interest and dividends from cash and securities held outside the insurance subs.
So it gives you this picture, doesn't it? A diverse group, but likely businesses Munger felt were durable or had some specific advantage?
Definitely. Durable businesses, strong cash flow potential, often with a niche focus. That seems to be the theme.
Okay, so with that portfolio, how did Munger frame the financial performance for 1997? What were the key numbers he highlighted?
He always made a distinction, which is important. He talked about normal net operating income, what the core businesses earn day to day.
Right.
And then the overall consolidated net income, which could include things like investment gains.
So how did those two compare in '97?
Well, the normal operating income showed good growth, up to over $38 million, about 5.38 cents per share. Solid progress.
That's the bottom line.
The consolidated net income, that soared. It went up to over $101 million, or $14.30 per share.
Whoa, that's a huge difference. From $38 million operating to $101 million net.
Yeah.
What caused that massive jump?
It was almost entirely due to realized net securities gains, over $62 million worth.
Realized gains, meaning they sold some investments.
Not exactly sold in the usual sense. A big chunk came from an exchange late in '97. They swapped their Salomon Inc. shares for preferred and common shares in Travelers Group Inc.
Ah, okay. And accounting rules forced them to book that swap as a realized gain.
Exactly. Accounting standards required them to mark that to fair value and record it as realized gain.
But Munger, being Munger, he put a footnote on that, didn't he?
You bet. He made it very clear that while it looked like a huge profit surge on the income statement, it had only a minor impact on WESCO's actual shareholders' equity.
Why was that?
Because much of that gain was already sitting on the balance sheet as unrealized appreciation. So moving it from unrealized to realized didn't dramatically change the company's overall net worth.
That's classic Munger, isn't it? Always pushing shareholders to look past the headline accounting number and understand the underlying economic reality.
Absolutely. Don't be fooled by the accounting presentation. Understand what's really happening with the value.
Let's circle back to that reinsurance business, WESCO, especially the super catastrophe part. Munger had a knack for explaining complex things vividly.
He really did. First off, WESCO had that crucial AAA claims-paying rating from S&P. You absolutely need trust and perceived financial strength in that business.
And how did he describe the business itself?
He called supercat reinsurance very logical for WESCO, but stressed the need for immense financial strength. That's where his famous Fort Knox analogy came in.
Fort Knox, meaning?
Meaning WESCO had to be financially prepared to potentially pay out claims many times larger than the premiums received in a single year if a truly massive catastrophe like Hurricane Andrew hit. You couldn't just be adequately capitalized. You had to be overwhelmingly strong.
That paints a picture. You need that fortress-like balance sheet. And wasn't there a specific arrangement with Berkshire Hathaway on this?
Yes, the retrocession arrangements. Basically, WESCO wouldn't take all the risk itself.
How did that work?
Typically, WESCO would keep 20% or less of the risk on a specific supercat policy. The rest, at least 80%, was passed on to Berkshire Hathaway.
Ah, so Berkshire took the lion's share of the identical risk.
Exactly.
Yeah.
And WESCO paid Berkshire a 3% ceding commission for this. Munger called this more than fair.
Why more than fair?
Because WESCO got the massive benefit of leveraging Berkshire's reputation and, frankly, its even larger financial strength. It was like having the ultimate big brother backing you up. Smart structuring.
Makes sense. Get the benefit of the association. But Munger was also very blunt about the downsides of this business, right?
Oh, completely. No sugarcoating. He flat out said supercat reinsurance is not for the faint of heart.
Why not?
Because results would have huge variation year to year. He warned that very unpleasant future years are inevitable. You will have years where you lose a lot of money.
But despite that volatility,
He still expected acceptable long-term results if you were well-financed and disciplined in your decision-making. It's all about surviving the bad years to profit over the long haul.
and he even gave an update on how they were doing up to that point.
Yeah, he mentioned that as of early March '98, WESCO had actually experienced no loss whatsoever on the supercat policies written so far.
That sounds great.
It does, but even then, he tempered it by noting they paid out some no-claims contingent commission. So even in a loss-free period, there were costs, always managing expectations.
What about other significant investments WESCO held? And I think this letter has one of those classic Munger quotes about being wrong.
Yes. Beyond the main operating businesses and Freddie Mac, WESCO held convertible preferred stocks, notably in Travelers Group Inc. and U.S. Airways Group Inc., about $52 million at original cost combined.
Convertible preferreds, not usually seen as a home run asset class.
Right. But Munger highlighted some big wins they'd had. The Gillette Company was a standout. They put $40 million into Gillette convertible preferreds back in 1989.
And by year-end 97.
That $40 million stake was worth over $321 million. A $281 million gain. Huge.
Incredible.
Yeah.
Any others?
They also had a nice gain-selling Champion International Corporation preferreds in 95, made about $6.9 million pre-tax on a $23 million investment.
So they actually did quite well with these convertible preferreds.
They did, and that brings us to the quote you mentioned. Munger writes, referring to their past comments, "We previously noted that few, if any, investors have ever prospered mightily from investing in convertible preferred stocks of leading corporations. Our experience proves, yet again, what poor prognosticators we are."
Huh. That's fantastic. He points out a massive success, then immediately mocks his own previous prediction. That's peak Munger humility.
Isn't it great? It shows that willingness to learn, to admit when experience contradicts your prior beliefs, even when the experience is positive. That intellectual honesty is so key.
Absolutely. Okay, shifting gears a bit. Munger always went beyond just the income statement. He dug into concepts like net worth and intrinsic value. How did WESCO's net worth look at the end of 97?
It grew significantly. Net worth hit $1.76 billion, which worked out to $248 per WESCO share.
And how did that compare to the previous year?
Up considerably from $1.25 billion, or $176 per share, at the end of 96. So strong growth driven mostly by that investment appreciation and retained earnings.
Now let's talk about one of his more nuanced insights, this idea of an interest-free loan from the government. What was he getting at there?
He was talking about deferred income taxes, specifically the taxes WESCO owed, but hadn't yet paid on its unrealized investment gains and other deferred gains.
So because they hadn't sold the appreciated assets yet, they hadn't paid the capital gains tax.
Exactly. And that money, the amount they would eventually owe in taxes, was still held by the company working for it. Munger likened it to having an interest-free loan from the government.
How much did that loan amount to on paper?
On a per-share basis, it was about $102 per WESCO share at year-end 1997, a substantial number.
But knowing Munger, he wouldn't just leave it there, right? He probably dug deeper into its real value.
Precisely. He explicitly stated this was not a permanent advantage. It wasn't free money forever, because eventually those assets would likely be sold, and the taxes would have to be paid. So it's a timing advantage, not a permanent one.
So how did he quantify the true present value of that timing advantage?
This is where his rigorous thinking comes in. He didn't just take the $102 at face value. He estimated its actual present value to shareholders was only about $25 per share.
Much lower. Why the discount?
Because of the inevitability of eventually paying the tax. He discounted the future liability back to its present value. It's a crucial distinction, recognizing the difference between a temporary float and permanent capital. A powerful lesson for anyone looking at balance sheets with large deferred tax liabilities.
Don't mistake a temporary benefit for true lasting value. So how did he pull these pieces together to estimate WESCO's intrinsic value?
His method was straightforward. Take the liquidating value per share, the $248 net worth, and add the real estimated value of that tax deferral advantage, the $25.
Okay, so $248 plus $25.
Gives you approximately $273 per share as his estimate of intrinsic value at the end of 1997, which, by the way, was up a healthy 39% from his estimate the year before.
And how did that $273 intrinsic value estimate compare to where WESCO stock was actually trading?
This is fascinating. On December 31st, 1997, WESCO stock closed at $300 per share.
So it was trading about 10% above Munger's own estimate of its intrinsic value.
Exactly. Even by his own calculation, the market price was a bit ahead of the underlying value at that moment.
And did he offer any broader commentary on the market environment at the time? It was 1997, leading up to the dot-com boom.
Oh, yes. He didn't hold back. He explicitly cautioned about frothy markets for securities. Classic Munger language.
Frothy markets. What else did he say?
He warned that fluctuations could be dramatic on the downside and that there was no guarantee as to its ultimate full realization for all that unrealized appreciation on the books. Basically, don't count your chickens before they hatch, especially when markets feel bubbly.
Did he compare WESCO directly to Berkshire?
He did, and quite bluntly. He stated that the business and human quality in place at WESCO continues to be not nearly as good as that in place at Berkshire Hathaway.
Wow, that's direct.
Very. He went on to say that each dollar of book value at WESCO provided much less intrinsic value than a dollar of book value at Berkshire, and that gap had actually been widening. Tough love, perhaps, but honest.
But even with those warnings about frothiness and the quality comparison, was he pessimistic overall?
No, not on a long-term basis. Despite what he called the super ebullient markets, making it hard to find good investments right then, he said, "We are not now pessimists on a long-term basis about business expansion."
So he believed good opportunities would eventually show up again.
Exactly. Patience and discipline. He also noted, just as a final point on performance, that WESCO had slightly increased its regular dividend from 27.5 cents to 28.5 cents per share, a small sign of ongoing progress.
What an incredible amount of insight packed into one letter. We've really covered a lot, WESCO's specific businesses,
Yeah.
Munger's very candid take on the financials,
Yeah, his views on reinsurance, that great humility quote, the deep dive into intrinsic value versus market price.
and those timeless warnings about market behavior and the importance of understanding true economic reality.
It really showcases Munger's whole intellectual framework, doesn't it? It's not just about a company in 1997. It's a masterclass in thinking clearly about value, risk, and even your own limitations.
Absolutely. So as you think about all this, maybe reflect on Munger's rigor. How does his way of dissecting intrinsic value, his skepticism about those frothy markets, challenge how you look at information?
Right. Beyond just the numbers on a page, what does it really mean to grasp the underlying quality of a business, an investment, or maybe even just an idea or a situation you're facing?
Yeah, are there things in your world, maybe temporary advantages or surface level appearances, that you might be overvaluing? Like Munger warned about that deferred tax loan. Something to definitely think about.